change of plans today. We're gonna go real negative, real deep. Not today. Are we rolling? Okay, so today I was gonna go down a deep rabbit hole, as you know we can do around here. It was gonna be a little bit too negative, so I'm gonna save you and pull you right out of that. But just to give you a Cole's Notes, it was on our beloved CMHC. Who is CMHC? Canadian Housing and Mortgage Corporation. This is naturally a crown corporation paid for by you, him, and me, and many millions others. And you wouldn't probably hear of them unless they gave a wrong forecast in the news, which they're known for, or you're going to get a mortgage and you wanted to put down less than 20%. Then you need an insured mortgage. So on their website, they say, we are driven, Al, by one goal: housing affordability for all. Do they make housing cheaper? No. I got some CREA stats here, Canadian Real Estate value growth rates specifically, that's Canadian Real Estate Association. 2020 rates were up, values were up 13%. 2021 home values were up 21%. 2022 home values were up 2.4%. So they're definitely not making housing fundamentally cheaper, which is what their slogans state. Then you look a little bit deeper and then you hear, well, how do I know these people? Well, your mortgage broker or your bank probably mentioned them. Because when you put down less than 20%, you can get a cheaper rate and you can still get the mortgage at 90% loan to value, so equity to loan amount, loan to value ratios, or like as low as 5% down or under 20%, but there's a little premium, which gets all blended up and you don't notice it. But that premium is an insurance premium. So they're offering you insurance payments for coverage of the bank. So if you, the shaky little home buyer, default, the bank has coverage. So you as a taxpayer pay for this conglomerate, it's not a conglomerate, huge company to basically protect the banks and make access to money easier for people. So if that's what they mean by housing affordability for all, I would argue they're embezzling money from the taxpayer, but that's what it is. So the caveat of what I was going to go into, and I've already touched on it too much now, is that they paid out $75 million in bonuses since 2020. And since 2020, housing prices have gone up. Their market share of insurance coverage for the banks has actually gone down since 2020. And since 2020, in bonuses and pay rises, they've paid out $93 million, taxpayer dollars, with zero pay cuts to their staff. And the staff has grown something ridiculous as well, but I'm not gonna go into it. So that was the road I was gonna go down. How CMHC is, I'm gonna just say it, I'm gonna use the word embezzle, but stealing, forcibly taking and paying out absorbent amounts with no justification, but that's too negative, okay? So we're scrapping that. That was the Cole's Notes. You're never gonna hear any more of it from me because that would have turned into a political conversation as well, which we don't do on this channel. So as a lighter tone, we're gonna go into a BNN Bloomberg report that was done last week, August 22nd to be precise, titled "Canada Sitting on the Largest Housing Bubble of All Time." That is a bold statement. All goddamn time, Al. A young Phillip Colmar from Global Strategies at MRB Partners says we have stretched housing prices, weak affordability, over-leveraged mortgage borrowers. Quote, Canada is probably sitting on one of the largest housing bubbles of all time. Keyword there being probably. 2 decades of easy money via monetary policy. I mean, the rates have relatively gone up and down, but specifically in the last decade have catered down. I think when I started in the business back in I don't even remember what year it was, 15 or 16 years ago, however long ago that was, 2007. Rates were at like 6%, and they've kind of slowly trickled down from there, and of course, flown back up since. But yes, there's been loose policy, and obviously without that cheap money, the prices would be nowhere near where they are today. I truly believe it's not just a supply and demand issue out there, which is a nice little guise, but no. The worst part of the housing bubble is when you have a credit bubble underneath it. So he's also highlighting there's definitely a risk here that if mortgage rates go higher, or unemployment were to rise, or we hit the next recession, then this does end up in a deleveraging cycle. That is smart person talk for softening of market values. So let's dive into that a little bit because it's a very large claim. We've heard all these claims before. Vancouver is the most unlivable city or top whatever. I've got a friend in Sydney, Australia, the center of the earth. And he sent me a picture the other day from their news, which of course now is not gonna show up. Okay, and they said something like Sydney, I think Singapore and Vancouver were like the top 3 unaffordable cities. Anyway, I don't know what metrics they use on that, if it's always the same old income ratios to this. We'll dive into a few other things here why. We're gonna try and debunk this whole thing here. So of what this guy's come to the table with. So to start with, StatsCan, variable interest rate payments have grown 12.6% a quarter. So variable interest rate mortgages. If you haven't locked in, you've been exposed to 12.6% growth a quarter or 69.7% growth of interest payments from Q1 2022 to Q1 2023. That's not a surprise, specifically to anyone that watches the news or has or had a variable rate mortgage. Next point, the decline in household disposable income, household credit debt as a portion of household disposable income is up to 184.5% in Q1 2023 from 181.7% in Q4 of 2022. Yes, that means that people have 184.5% debt exposure over their income. That's an interesting one. But as you know, we can play Tetris and musical chairs or Jenga, and you can pay a bill here and pay a bill there and hold it all together like a beautiful little web of debt, which is quite scary. But anyway, RBC reports residential mortgages with amortization surpassing 25 years was up 40% year over year. We've all heard of the pushing amortizations. We've discussed that, and I'm gonna go into that again in a second. TD reported a raise of amortizations over 25 years, 35% up year over year, and both have seen spikes in amortizations over 35 years in the last year. So of course, anything is possible from all of that. We know people are struggling out there, which is very unfortunate. We hope that September 6th is the next meeting with the Bank of Canada, Tiff Macklem, and that they hold, and that they're now holding in their holding pattern. A little hot in here, though. And that they will no longer be raising. There's a few things on the table which may dictate that decision either way, but obviously we are hoping that no more raising is taking place, but we'll see. Hopefully that's the case. Hopefully people can hold it together. Now, how we can combat this claim. So, and now these are the points. This is not a script as we discussed the other day, okay? Just for the record. Because I keep looking down, this is not a goddamn script. That was insulting, heavily insulting. So Canada's packed in $11.2 billion in mortgage debt as of Q1 2023, says StatsCan. So a relatively slow quarter based on record quarters Q2 of 2021 and 2022. The people taking these mortgages, of course, however, are qualifying at current stress test levels. So we'll get into in a second who's picking what type of mortgage vehicle, but if you're qualifying at 8% and you're actually buying today, you can afford to make that payment. It's not like you got qualified years ago and now things are dramatically higher. The bank is saying today, yes, your debt service ratio equation based on your income and how much money you're putting down is comfortable to us. We believe you are not going to default and that you are a good risk. So come on in under the umbrella, take a loan. You've stress tested at basically 8% and we're going from there. So people today that are qualifying are typically taking fixed rate mortgages for shorter terms. We've gone over this. Typically before, variable 5 years was very, very common, which we'll get into, and that's shrunk dramatically. And today people are taking the shorter terms, again, assuming that that interest rate holding pattern is here, hopefully, or coming soon, at which time in 2 years rates will be cheaper, so then they can dumb down from there and not take that full 5-year term. So in every mortgage broker I've spoken to, there's a lot more of that taking place, which is kind of assumed. So those people entering the market today at this 11.2 billion in the first quarter seems like a big number, of course, but they are as qualified as can be to enter the market today. So they're not really of a concern, in my opinion. The most exposed people naturally are people who have been on variable rate mortgages and have felt this all the way up, and maybe they've fixed in at some point, locked in, but they've been pre-qualified in a different market, a different environment, and they've been hit with the rate increase. And of course, those people who may be fixed and coming out of their fixed terms and reterming now in this highly escalated market. For example, I've talked about my own mortgage. I'm at 2.95%, 5 years. I looked yesterday, January 2025. I will have to renew. Hopefully that the rates are softened by then. And then when I come in, is it a huge hit to me or not? I've got time, obviously. Can I make balloon payments in the meantime? That's what everyone has at their disposal, depending on income levels naturally. But those are the people most at risk here. So the people that have experienced it and the people that are reterming in this super high rate environment. Now, StatsCan again, January 2022, before the rate increases began, March 2022, 56% of mortgages issued were variable. So, April 2023, that turned into just 8%. So you can see a dramatic drop in variable, selected variable mortgage, and people are taking the fixed, which again goes back to all of those people, that 11.2 billion in mortgage exposure that's been taken Q1, fixed rate for the majority, short term, we're good. Just to touch on that as well, I went in here, debt outstanding in Canada. So this is kind of interesting. Total outstanding mortgage debt in Canada Q1 2023, $1.7 trillion. Vancouver is 191 billion of that. HELOC debt in Vancouver, 23 billion. Line of credit debt, 3 billion. Auto loan debt, interesting, 3.4 billion. Credit card debt, 7.6 billion, and all other types of debt, 8.8 billion. Lots of debt out there. But that, again, we are in second place behind Toronto in mortgage exposure. A quick third is yield Montreal. But just to show, I don't have a year over year from that. I didn't want to get too deep into that, but we've got the bulk in fixed rate now, secured, qualified, good to go. And remember, typical borrowing is 5 years. So every year, 1/5 of the mortgage population is turning over their mortgage, turning over their debt, having to renew. So we've gone through year one, basically, of we're at year 1.5 of rate increases now. So we've got 3.5 years left of people that have been exposed to this increase. And basically, you just got to hang on and wait for those rates to drop. Don't lose your job. Easier said than done. Tighten up the reins and keep paying. So the most recent figures from the Canadian Bank Association show that the national rate of mortgage default is at a historic low as of January 1st, 2023. January 31st, 2023 was almost a year of increase. So obviously we've had increases from then, but again, national mortgage rate for default is at a historic low after year one of this dramatic, some would say violent rate increase. Which is 0.16% of Canadian mortgages were in arrears, which translates to 7,909 mortgages across the country were in arrears. I think arrears, they're considering 90 days overdue in payment. Okay, so from there, now, why else is this not going to, how else are we going to debunk this? Well, the government has intervened as we went through a few months back. July 13th, I did a video, The Endless Mortgage Amortization, and that video was about the government intervention in the current environment. So another reason why I think his calls for the biggest bubble of all time will not pop, that we've got quite heavy government intervention that just finally now has begun. So they mandated the banks to pass down options to tap into relief plans, payment deferrals, extended amortizations. Again, just to name a few, waiving payment penalties on lump sum payments to avoid negative amortization, or property sales, waiving internal fees and costs, no charging of interest on interest, which again, I thought that was illegal anyway, but they've highlighted that here, so it's still going on. No further interest over fixed payment amounts owed. Banks cannot offer less advantageous rates. Slippery slope again. At renewal based on consumers' inabilities. At-risk consumer credit reports do not reflect late payments or delinquencies in payments. So those get cleared off the slate. As we talked about, extending amortization is taking place. When amortization periods are extended, they try to structure the shortest amount of time possible for that extension, making amortization periods reasonable, including info about restoring amortization to original periods, including assessments and communication of the potential long-term negative financial implications of what they're doing, and of course communicate this in a manner that is clear, simple, and not misleading. So the bank is pushing a lot down onto the people as they were mandated from the feds to assist. Now, like we say to our first-time home buyers, there's no such thing as a stupid question. Go into your bank and ask, what is the mortgage relief option that I have? Remember in COVID, a lot of people took that mortgage relief option, deferring payments for up to 6 months. There was no prerequisite for that in like proving financial hardship or anything like that. If you asked, you got it. So I'm guessing to a certain degree this is going to be the same. So if you're in trouble, which hopefully you're not, I suggest you go to your bank and ask them, what sort of relief do we have at our disposal here? Because you're much better off extending your amortization, holding the asset, than crippling yourself. If you are being crippled under the current circumstance. Prices haven't adjusted dramatically at all, so depending on how far back you bought, you are probably still in the green, generally speaking, but there are options out there, so you know. Now, another reason why I think we've got a bit of buffer from this, in looking at this is a very skewed number as well. I've never really been able to hammer down. Stats Can numbers are back in 2020, unfortunately. Higher than average income levels in Vancouver than across the other provinces and territories. That's 10 provinces and 13 provinces and territories. 3 territories, 10 provinces. Al, did you know that? I forgot that and relearned that last night, just so you know. Stats Can 2020 details average Canadian income $66,800. Alberta sitting at the highest at 77, then Ontario at 73, then BC at 68. Not to say that because we've got higher income, we're good. Yes, there's higher real estate prices here, but let's hope that not everyone absolutely maxed themselves out. So that's a little bit of a buffer. But again, I've heard circumstances like average income in Canada is 60 and Vancouver is 80. I don't know the actual numbers. There's a lot of avenues you can check that. And the official government, which shouldn't be solely trusted, of course, either, are dated a little far back. So it's a bit difficult to find. Now, Canadians historically hold on to their mortgages at the expense of other credit outlets, meaning you will pay your mortgage every time, and when things get tough, you will sacrifice other bills before you sacrifice your mortgage. Now, if you miss a payment, the bank is not going to foreclose your house. Arrears, they will try and work with you. That's 90 days of missed payments, so 3 months. So if you pay monthly, 3, I pay weekly. 4, 8, 12 payments, whatever that is. The bank does not want a piece of real estate on their hands that they have to go engage a realtor and sell. That's very down the line. So yes, the big bad banks have bad reputations, but at the end of the day, they don't want your real estate. They want your little wee interest payment, or not so wee anymore, on the money they borrowed you. That's what they're in the business of. And that's why they're so powerful, not because they are real estate traders. So they will help you, they want to help you, they do not want you to default. And Canadians, again, historically have always held that mortgage payment with a gold plating around it compared to all others. You're fine to miss a mortgage or a credit card payment, I don't know, school tuition payment for the kids, a Netflix payment. I don't know what happens if you miss a car payment, but historically we've been very good at keeping that at the top. So that we've got going for us as well. That home, we can shed everything else, but the last thing that will need to be shed is, of course, the roof over your head. And I think that is amplified when there's kids involved and comfort levels and all that. And again, finally, 50% of our owned homes are mortgage free, as they didn't tie into, as we went over 2 weeks ago. So that in itself removes half the people. Now you're dealt with 50% of homeowners that have mortgages. And from that 50%, obviously not everyone is stretched. So let's cut that in half again. And then let's say you've got all these options from the bank. So there's a lot of options, and there's a lot smaller pool of people that I think are actually susceptible to all of this hardship that he's talking about, or potential hardship that he's talking about in this article. So I don't really see it. I don't want to sound like real estate always goes up, because obviously it doesn't. I don't want to sound like we're totally invincible, because we're not. Of course, with 50% of that home ownership being mortgage free, we've had a massive influx of immigration. That's outside money. That's not applicable to the debt loads and all that sort of stuff that he's talking about. So I think these points are what is keeping mortgage defaults at a minimum still. Are there defaults out there? Obviously, I'm not seeing much, but obviously in the scheme of the country, I'm seeing like a pinhole. But here in Vancouver, very few I've seen. I've talked to 0 clients personally who are under hardship and have decided that they actually want to sell. But again, are these aspects simply kicking the can down the road, or are they actually the reason that we are not going to see hardship? That we don't know yet. That leads to the final point of another thing he touched on, which is job loss. So we haven't at mass really seen job loss based on the big kind of R word, recession. What does that mean? Oxford Dictionary here: a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 consecutive quarters. So what does that mean to you? It doesn't really mean anything unless you lose your job. So decline, people lay off. If you're unfortunately one of those, yes, you're going to be in a circumstance, but I think hopefully we are at the pinnacle of the rate increases now, about to enter our holding period before they start dropping. 50% of economists interviewed feel we will have a recession in the next 2 years. 50% think we will not have a recession in the next 2 years. Who knows? Is that bad? I don't think it matters either way to you unless you actually get laid off because of it. And the chances of that are probably, hopefully, slim. But what do I know? So I think those are the reasons that we are buffered from this specific article and his reasoning behind why we are in the biggest bubble in history here in the beautiful Vancouver, BC real estate market. Al, do you have anything to add? Do you agree with any of this? Is it all bull? That's it. There's a little element, a little air of negativity in that one, but there always has to be a little touch. We're not going to do the CMHC one, so that's erased. And that's it. If you have questions, thoughts on what's going to happen in the market, comment below, of course. Always like and subscribe. I got to start saying at the start of the video because people are going to listen to 10 seconds, turn it off, and at least they know that. That's what we appreciate the most. And I will see you in a week. Thank you and good night.